Hello, I'm Steve Balch from Certa Financial Planning, here to give you our market update for July. From a macro stance update, we continue to stay the same for now, but we are starting to get a lot of mixed signals. The market trend continues to be positive, with another positive return in June. However, market participation and breadth is thinning. With summer months here and seasonal volatility potentially picking up, we will watch to see if changes are needed in the coming months. The Fed policy continues to be neutral. The Fed held rates steady at their June meeting as expected. The focus continues to be the September meeting when the first rate cut is expected. The Fed wants to see further evidence that inflation has cooled before cutting rates, and their data implies only one cut in 2024. The market expects one in September and one later in the year. The spending in Washington has no end in sight, so fiscal policy remains positive. Economic leading indicators continue to be positive, but are mixed. Jobs had a surprise increase in creations for May, showing the economy continues to be resilient. However, there may be signs of weakening as the Atlanta Fed's GDP Now measure recently ticked down to 1.7% from the 2.2% reading in June. Valuations continue to be neutral. U.S. large cap growth stocks continue to be expensive, but with the AI boom, earnings continue to justify higher ratios for now. For the market regime and business cycle reading, nothing has changed. We continue to stay in a reflationary regime. This regime happens when inflation and growth are both increasing at the same time. This environment is still a risk-on environment and positive for growth strategies. The business cycle. The U.S. business cycle continues to stay in the late stages as growth has slowed, but we have moved back in the stage as there have been signs of stabilization. We'll get an update in the coming months if this has moved back or down in the late stages. The three questions we're monitoring this month and for the rest of the year. What does a strong first half of the year mean? Will the low volatility continue? Do presidents impact the market? What does a strong first half of the year mean? The S&P was up double digits at the midpoint of the year, making it one of the best first 6 months of an election year ever. Historically speaking, when we see 10+% gains in the first half, the full year return have been positive, up 25.1% on average. Additionally, the second half of the year tends to be higher 83% of the time, with an average return of 7.7%. This bodes well for the next 6 months. However, even though the first half of the year has seen double-digit gains and historically low volatility, this may mean that more volatility is here to come. The max correction for the S&P 500 this year is only 5.5%. This pullback is quite low and suggests that there is more volatility on the horizon. If the 5.5% is the largest pullback we get, it would be the smallest pullback for an election year since 1972, which was 5.1%. The average election year correction is 13.1% since 1950. As the second half of the year starts, the focus for many investors is going to be the election year in November and how it will impact the markets and the economy. The reality is the outcome will have little impact on the success of the markets. Headlines will dominate from now until the end of the year, but making major investment decisions based on a president's political party, i.e. being invested only during Democratic presidencies, then moving to cash for Republican tenures, or vice versa, is probably hurting your portfolio more than helping it. The reality is, if companies are making money and the economy continues to grow, the markets will continue in an uptrend. Regardless of the party occupying the Oval Office, staying invested is the most prudent long-term strategy. Our positioning and outlook. Our models continue to stay in a neutral stance on growth, tactical, and alternative strategies, while underweighting preservation. Even as the market continues to make new highs, mixed signals are forming and we are entering a historically volatile time of the year. This does not mean we have gotten negative on the markets. A strong first half with 20 or more all-time highs is a good thing, like we just saw. Historically, this has meant more all-time highs will come with an average of another 20 in the second half of the year. However, we are being cautious in the short term and do not want to be caught extending risk in this current environment. As always, we'll continue to watch and adjust portfolios as needed. We thank you for watching. As always, please feel free to forward this to anyone you think can benefit from the information. If you have any questions, please feel free to reach out to us. Thank you again for watching. Have a wonderful holiday weekend. We wish you a great 4th of July and stay cool.